Hey investing fam, welcome back to the channel. In today's video, I want to dive into a topic that I get a lot of questions about: high-yield ETFs and why I've chosen to invest a portion of my portfolio in them. For those not familiar, high-yield ETFs, also called junk bond ETFs, are exchange-traded funds that track baskets of lower-rated corporate bonds. These bonds offer higher yields than investment-grade bonds, but also come with higher risks. Now I know what some of you might be thinking: junk bonds? That sounds super risky. And you're not wrong. This part of the bond market definitely carries more risk than government bonds or highly rated corporates. But when used properly as part of a diversified portfolio, I believe high-yield ETFs can be a valuable addition. So let's jump into the reasons why I've decided to allocate part of my investments to this asset class. Reason number 1, increased income potential. Let's start with the obvious: high-yield bonds pay much higher interest rates or coupons than other areas of the bond market. We're typically talking about yields in the 5–7% range or sometimes even higher. For income-focused investors like myself, that's an attractive stream of interest payments to receive, especially in the low interest rate environment we've been in for over a decade now. Those yields dwarf what you can get from treasuries, investment-grade bonds, or even most dividend stocks. Reason number 2, diversification benefits. While high-yield bonds do have higher volatility than other fixed income, adding them to a diversified portfolio can actually reduce overall risk at the right allocation level. That's because junk bonds tend to have low or negative correlations with other asset classes like stocks and investment-grade bonds. So when one part of your portfolio zigs, high yield could zag, smoothing out the volatility. For example, high-yield bonds held up relatively well during the early 2000s bear market, providing diversification benefits. Reason number 3, equity-like returns with less volatility. Over longer periods of time, high-yield bonds have generated returns that are similar to stocks but with lower volatility. Just look at the numbers over the past 20 years through 2022. High yield returned around 7% annualized based on major indexes. That's not too far off from equity market returns of 9–10%, but with about 2/3 the volatility of stocks. So you're getting that income component we talked about earlier, plus the potential for solid total returns, but with less gut-wrenching ups and downs compared to an all-stock portfolio. Reason number 4, opportunity after credit cycle downturns. This next reason is more tactical, but I view periods of high-yield underperformance as potential buying opportunities. The high-yield bond market tends to be cyclical in economic downturns. We see an uptick in defaults and spreads over treasuries widen out as investors demand higher compensation for risk. But when the economy turns back up, high-yield bonds can rally strongly as default fears subside. By buying when spreads are wide and sentiment is overly pessimistic, you can position yourself to capture that rebound as the credit cycle improves. Reason number 5, active management opportunities. Finally, one aspect of high yield that I really like is the opportunity for active management to add value. Compared to areas like treasuries or investment-grade corporates, high yield is a fairly inefficient market with a lot of complexity in analyzing individual bond issues. For that reason, I've invested a portion of my high-yield allocation in actively managed mutual funds and ETFs run by experienced fixed income teams. While I'm a fan of passive index investing in general, I do see active management as a potential edge in this space. Now let's talk about risks and how I'm managing them within my portfolio. Risk management. As I mentioned up front, investing in high-yield bonds definitely comes with its risks. A few key ones to be aware of. Default risk. The biggest risk is that the issuing company will be unable to make scheduled interest payments or repay principal at maturity, i.e. they default on the bond. That's why these are called junk bonds. They have higher default rates than investment-grade issues. Interest rate risk. Like all bonds, high yield is exposed to interest rate risk as rates rise, bond prices fall and vice versa. However, with high yields higher coupons, this risk is somewhat mitigated. Liquidity risk. The high yield market is not as liquid as other areas of fixed income. so there can be periods of poor tradability that create wider bid-ask spreads. To manage these risks in my portfolio, I stick to a few important principles. 1. Reasonable allocation. High yield makes up only 10–15% of my overall portfolio to limit my downside exposure. 2. Diversification. I'm invested across multiple high-yield ETFs and funds to diversify my exposure. 3. Quality focus. Within high yield, I overweight BB-rated bonds which are on the higher quality end of the spectrum. 4. Active plus passive. I combine passive index ETFs with actively managed funds for diversification. By following a balanced, risk-aware approach, I feel I can capture the potential benefits of high-yield bonds while keeping the risks in check. Wrap up. Alright investing fam. Hopefully this gives you a solid overview of why I've decided to invest in high-yield ETFs and how I'm managing the risks involved. To summarize, I like high yield for the attractive income stream, diversification benefits, equity like long-term returns with lower volatility, opportunity to buy on weakness, chance for active management to add value. But I'm also very focused on controlling risk through a reasonable allocation, diversification, quality focus, and combining active and passive strategies. At the end of the day, no investment is risk-free, including high-yield bonds. But I believe they can play a valuable role in a diversified income-focused portfolio when implemented properly. Those are just my thoughts, though let me know if you agree or disagree with high yield as an asset class in the comments below. And make sure to subscribe for more investing content coming soon.